Hello and a very warm welcome to What NEDs Need to Know, what non-executive directors like you and those that you work with need to know, especially on the subject of ESG, environmental, society and governance. I'm Ollie Barrett, and it's an honor to be your host for this event brought to you by finnCap. I'm sure you know this already, but finnCap excel in supporting all sorts of hugely ambitious teams around the UK, especially on the AIM listed market. And we'll hear lots more about how they do that and why they do that in due course. Of course, this is a virtual version of an event we've held several times face to face. So no coffee and croissants unless you brought your own this morning. The simple fact is that with an increasing pressure on institutional investors to monitor and evaluate their ESG, this is the time for listed companies to be taking this very seriously indeed. So we hope that in this session, you'll learn something, you'll ask questions, and you will be inspired by the brilliant speakers that we've gathered. So let's meet them as I tell you who we've got gathered with us today. How brilliant to see Peter Michaelis from Lion Trust Asset Management. Good morning, Peter. How are you, sir?
Good morning, Ollie, and good morning, everyone. I'm very well. Thank you.
Good. Well, you're head of sustainable investment at Lion Trust, a renowned asset manager, and I'm looking forward to meeting you shortly, interviewing you for the first time today. Unlike Manjula Lee, who I get to reunite with. Manjula, how lovely to see you again. Manjula, you're the founder and chief executive of Worldwide Generation. Good morning.
Hi, everyone. Yeah, thank you for having me. I'm so excited about this discussion. So yeah,
we're going to hear all about Worldwide Generation. It's a fascinating platform that allows us to get a handle on how we're doing and where we want to go as well. Raymond Greaves, he's probably got his slide rule in his back pocket. Raymond is the head of research at finnCap Group. Good morning, Raymond. How are you?
Good morning, Ollie. I'm full of a cold, but at least I can't spread it virtually.
Oh, that's right. I'm socially distanced through the screen. That's good. Well, we'll get you going this morning, Raymond. Nice to see you again.
Nice to see you all, thanks.
Alexander Rhodes is the head of purpose. What a great role at Mishcon de Reya, that globally renowned law firm. And it's great to be connecting with you for the first time. Alex, how are you this morning?
Morning, Ollie. Very well. Hi, everyone. Good to be here.
You've got a great role. I want to hear more about why you set it up in due course. I'm looking forward to that, Alexander Rhodes. And by no means least, Sam Smith, known to you already quite possibly, is the founder and chief exec of finnCap. Good morning, Sam.
Morning, Ollie. Morning, everyone.
It's a bit of a reunion, Sam. We've talked about this many times. What a brilliant group of guests we have assembled.
Absolutely. Very much looking forward to the discussion. It's a really important one.
Well, thank you for being here and for encouraging us to convene this group. But for now, to all of our guests, to Peter, to Alex, to Raymond, and to Manjula, we'll see you shortly if you go and have a seat in our virtual green room. And Sam, maybe I could start by asking you why this theme, why ESG is so important to finnCap Group, to you personally, and why you felt it's so important to put on this event today. But over to you.
Yeah, so doing the right thing, as I call it, has always been hugely important to finnCap. It's why we set up 14 years ago. And from the very start, I've always believed that all stakeholders are equally important. So as well as profit and your shareholders, it's equally important to prioritise your team, your clients and your community. So I consider ESG to be about doing the right thing. But yet 14 years later, I'm looking at a business that's always been about that and thinking, well, how do I actually measure it, report it? How do I actually prove to our investors, now that we've been on AIM for over 2 years, that we are actually this company doing these good things? And that then became much, much harder. So why after 2 years on AIM did we suddenly think about this in the middle of a pandemic when there was obviously a lot of other things going on? And what became very apparent to me, probably in April, just a few weeks into the pandemic for us, was that there was a real reprioritization and a refocusing for not only business, but for consumers, employees, and investors on how everyone should be benefiting society in a much broader way. And the trend to put ESG on the top of your agenda was just accelerating and going to accelerate so fast. So the S, particularly in ESG, was starting to become a really big issue. And what we saw is companies that were really succeeding were those that had a very human response, which was quite different to the past few years. So that really put it into focus. And we sat down with Raymond and said, okay, let's look at how we lead this. We want to lead the charge on reporting. How do we do it? So Raymond will talk to you about that in a minute. But at the end of that, we said, look, there's this wall of money coming in. Everyone knows the rise of funds coming into ESG and impact funds, but there's also a broader need for investors and fund managers to show how they are analysing companies, what they're doing at a base level. And where we saw larger companies having resource to be able to do this, lots of very purpose-driven companies had B Corp status potentially to go for. The small mid-cap market, we felt there was a real gap in how do you report, because you haven't got hours of time and money to spend on just ESG alone. So how do we do it? So Raymond will talk about later, but we came up with a great ESG scorecard, which is a 15-question, very easy, what we call rung one of the ladder to really help people start reporting. We partnered with WWG back in December to form a partnership because we thought their software was the best and easiest to take you to rung two of that ladder. So we have now, as finnCap, started to use both of those to report. We put them in our annual report, they're on our website. And we found that actually, as a company that's always been about doing the right thing, it's actually helped us to continue positive change and think about things that we wouldn't have otherwise necessarily had as a front of agenda. And we now have ESG as a full board component, every board meeting to discuss. So as finnCap, we want to make sure SMEs don't get left behind. The pace of change of this is coming so fast. We really think it needs to be on everyone's radar now, not only to be as investable as you possibly can as a company, but also so you don't become uninvestable. So that's our take on it.
Yeah, that's fascinating, Sam. And on a scale of sort of, a bolt from the blue to, you're speaking their language, when you speak to the most ambitious high growth companies about this theme, about ESG, where are most of them sitting? What's the sort of response you're getting?
Well, there is a difference between the company itself, how they feel about things, whether they are a purpose-driven company, whether they, lots of care about their team and doing the right thing. There's quite a difference between that and reporting. And I think that was our big insight, and Raymond will go into it later, that actually we were rung one of the ladder. After 14 years of doing this, we were starting from the beginning on our reporting. And so there needs to be that catch up really in terms of showing to the investors, this is what you're doing.
Yeah, that's a fascinating distinction, and actually not good enough, as you say, for the answers to these tough questions to be a series of anecdotes anymore. You hint, Sam, about a very powerful partnership with Worldwide Generation. So, but more of that imminently. For now, Sam Smith, thank you so much. See you very shortly.
Thank you, Ollie.
Founder and Chief Exec of finnCap Group. Now, WWG is led and was founded by Manjula Lee. Nice to see you, Manjula.
Hey, good to see you.
I think that this is a really important time for this conversation, and a non-exec director tuning into this call might think, okay, good to have on the radar, one probably to be thinking about maybe in a few years' time, to be conscious of. I think you're going to take a slightly different view as you tell us why now is the time. So the floor is yours, Manjula.
Thank you. Hi, everyone. I wish I could see you face to face, but the important message, it is now. The time is now. We, particularly due to COVID, we are the last sort of generation really in human history that can turn the plight of the planet around and deliver a sustainable future. The first thing I want to talk about is the Sustainable Development Goals. For those of you that haven't heard about them, they are 17 goals, 169 targets that the United Nations put out, linked to the Paris Agreement as well, that 194 countries, 1,000 cities, now most of the investor community, most of the business community have signed up to delivering this decade by 2030. So the first, if I can put up that first slide, when the SDGs actually were ratified and came out in end of 2015. What we had to, I was advising into the United Nations at the time, and I said, well, if we have to unlock about 2.5 trillion of extra capital to deliver these SDGs by 2030, you know, what's the missing ingredient here to be able to do that? And has anyone proven the economic argument of sustainable development? Because the only way we're going to unlock that amount of capital is if the business sector play their role and the proper capital markets play their role in this. So this first slide basically is a slide that we, all of the different economists, were working around and getting these numbers, and we saw incredible data that companies that were aligned to purpose, that were aligned to sustainable development, were outperforming on the stock market by over 11%. The new consumer market, which were going to be the millennials and the Gen Z, who are coming into the economic power, were going to adopt brands and leaders that can prove their impact on society and planet, and they would want to work for those companies as well. Something like 90% of consumers will convert to those brands. Now, we were also seeing, just by de-risking your value chain and your supply chain and making that greener and more efficient and more sustainable, was going to really impact the triple bottom line, as we call it, 14 times more revenue and profitability for those companies. Then the last figure is that if we invested collectively the 2.5 trillion of extra capital that was required, not only would we find a global resolution to poverty, inequality, and climate change by 2030, we would unlock something like 12 trillion global growth in new markets, never seen of any generation in human history. So when we saw all this data, I was like, wow, that's it. That's all we have to do. We just have to evangelize that message. I'm going to take that. That's why I started Worldwide Generation. No other agenda but to preach this message to the different stakeholders and say, here's the economic argument of sustainable development. So if we go to the next slide, so off I set. First community went to speak to were the investors, and I showed this data and said, hey, look at this. Surely you're going to pile into sustainable development today, right? Like this is the answer. And they said, Manjula, it's not because we don't believe, it's not because we don't want to. The issue we have, if we look on that far right box at the end, is that most of the data we get today is coming 2 years outside of financial data. So they're getting financial data in real time, they're getting non-financial data 2 years outside of that. Most of the data they get is being scraped from the public domain. So every time someone puts a report on a website, that data is being scraped, mainly for public companies only, and sent to the investor community. So not only is it out of date, there's very little trust and provenance on where that data has come from. And so they have to, as investors, buy lots and lots of data, then do something with that data to get it into some sort of comparability at a portfolio level, because everyone is monitoring and measuring performance completely differently. So their end statement to me was, Manjula, we believe, just give us trusted, comparable, timely data, and not just any old data. We need to know if, at the moment we're getting ESG ratings of companies. That's in someone's opinion if this company is good, bad, not so good. That's not good enough for us. What we need is to know if we invest in this company, are we going to move the dial from here to here? And that is impact data. So I was like, okay, so that was the world of pain the investor community were in. If I take you to that left box on the bottom left there. So went and spoke to the companies and public, private, SMEs, and said, hey, what's happening with you? You want to be more sustainable? I can see on your website. They're like, oh my gosh, that's a nightmare for us as well. We're in a world of pain too. We have to go on all these different portals, fill out all these different questions, all these different surveys, thousands of questions per survey. Every time we get a new investor, a new survey emerges, a new framework. First it's ESG, then there's SRI, then there's SDGs and TCFDs, and TLA is coming out of our ears. Manjula, we know how to create the products and services that's going to change the world. Someone's got to standardize and streamline the reporting. And there's all the people in the middle, the assurers, your auditors, they're in a world of pain too, right? It's so expensive for them to go and verify this data because they literally have to get on a plane and go and verify the information that companies are providing. And that is hugely expensive. So that was really the aha moment where we were like, wow, this is the crux of the market failure. It's not because of will, it's not because of capital, it's not because of expertise. It's because, number one, no one can execute. Number two, because no one can execute, no one can get access to trusted, comparable, timely data. Because no one can get access to that data, no one can measure impact and what's working, what's not working, and measuring the risk of where we are today. So that was where we pivoted from a company that was going to be like a think tank and a facilitator of all these organizations to get to deliver the SDGs to a technology company so that we could build a technology platform to solve that very problem.
Excellent. Thank you, Manjula. Well, that is tantalizing, if nothing else, because we want to see some of the fruits of your labors. And I know you're going to give us a sneak peek into what you've built later. But in terms of the why, I think that was incredibly clear. So thank you. And will you stay with us, Manjula, to share more about the journey in due course? Thank you.
Yes, absolutely.
That's Manjula Lee, founder of Worldwide Generation. If you're just tuning in, this is What NEDs Need to Know, brought to you by finnCap Group. Our next guest, Alexander Rhodes, is Head of Purpose at Mishcon. Yes, I'm as intrigued as you are. This sounds like a great job. Alex, welcome back. Thank you for joining us today.
Thanks, Colin.
Clearly, we've already heard from Manjula and indeed Sam why reporting has to be in the mix somewhere. I'm just wondering to myself as I talk to you, how useful is it to start with reporting?
Yeah, well, Ollie, reporting is really important. But I think actually Sam started off by telling us the right place to start. When she said, you know, her starting place was doing the right thing 14 years ago. And the reality is, if one starts by focusing on reporting, and if one looks at certainly the way that the legal frameworks and the regulatory frameworks are developing, be that TCFD or SFDR, this is all focused on transparency, and it's all focused on accountability. But it's effectively people telling business what they have to tell others.
Yeah.
Alex,
I'm just going to pause you there just incredibly briefly, because we've got a wide range of guests. But when we talk about TCFD, this is the Task Force on Climate-Related Financial Disclosures. This is important because it's going to effectively force people to share the impact they have on the planet, right?
Yeah, absolutely, Ollie, and thank you for the jargon in this area. Starting with ESG, of course, which you unpacked for us at the beginning, is impossible. But I think the point I wanted to make is that the way that the rules are driving are around disclosure, and obviously reporting is fundamental to disclosure. The risk in starting by looking at what you're being asked today to disclose, I think, is that it can lead into a very much a risk-focused, cost-focused mindset, which is led really by compliance rather than purpose. Fundamentally, what Sam said at the beginning articulates where this needs to where this needs to sit for businesses, which is that because it's such a wide suite of issues, you know, environmental issues, internal, external, social issues, workforce, human rights, and governance, you know, from integrity and corporate governance, is such a wide suite of issues that affect the whole business. When one's trying to think about how the business engages with these issues, it has to be from the top, and it has to be fundamentally led by what is the purpose of the business.
Yeah, and that's a really powerful distinction. Now, here I go, accidentally offending your entire industry. Sometimes we can think of lawyers as helping us to, you know, dot the I's, cross the T's, not put a foot wrong. Purpose seems more uplifting to me. So tell us why you set up Purpose at Mishcon and what it actually means in practice.
Yeah, so the reason we set up Purpose simply was because clients were asking for it. We had repeated conversations with corporate affairs directors, general counsel, chief executives, non-executives, directors, and just in that suite, it shows you where the variety of places where this ends up being owned within businesses. It doesn't have a home necessarily, because ESG reflects a whole suite of issues around corporate governance. And the thing that we were being asked was always the same. What is this sustainability thing? We know we've got to get on board with it, but how do we grasp it? And when we turn around to our professional advisors, we can get a bit of advice here, but it's very difficult to find someone who is focusing on trying to integrate all of these aspects into a cogent approach that can help us understand them. Because the challenge is, and actually the thing that unites ESG, is that these are internal risks that come from how you decide to run your business, rather than the icebergs that businesses have been very good at spotting through risk committees, that are out there and going to come and challenge the business.
And what about, Alex, what about the viewer that's thinking, very good point, I do need someone to talk to about it. I was planning to head off to my accountant. I'm not trying to set you up in opposition, but it might be on someone's mind.
Yeah, so I think this whole piece is around transition, and it's everybody recognizes that very businesses are where they need to be, but everyone is just on a different point on the journey. And so there's an initial step for people who aren't yet engaged, which is getting onto the wheel without getting a bloody nose. And then the people who are on the wheel, it's about, okay, how do we manage the risk, but actually in a way that will allow us to see the opportunities that are there and get the most of them. And typically, when one's looking at transitional risk in a landscape that is developing in a regulatory and legislative way, they tend to come to their lawyers. One, because lawyers are good at risk generally. Secondly, because it allows, certainly at board level, open and frank conversations to be had with the benefit of legal privilege where there are serious issues to be addressed. And it's more than once I've had a conversation with senior board members who have said, we know that actually we think we're pretty good, but we're not totally sure. Yeah. And we're a little bit anxious that if we start this conversation, where does it go, and how do we have it in a way that the conversation itself doesn't lead to risk that we're then going to have to focus on managing.
Yeah, that's very helpful. Can I put it to you, Alex, on the consequences of getting it wrong? I won't portray you as the harbinger of doom, but this is the reality in those board conversations. Give us a sense, and I've got to ask you to be relatively pithy. I could ask you about this for an hour.
Well, I think Sam articulated it in a concise way that I like, which was, this is about not just being investable, but not ending up being uninvestable. Certainly, the cost of capital we've all seen is reflecting the status of the way that businesses are managing this risk, and increasingly there's a regulatory, pressure coming on to be on the right side of it. I think the main thing for corporates, or the main risk for corporates, is not starting to look at this, because fundamentally, whether one's more concerned around the environmental side or the social side, and hopefully not too much on the governance side, this addressing these issues comes with a change in the business model, and that takes some time to bed in.
So what do you say then, Alexander, to the non-exec who says, look, yes, this is about doing the right thing. Yes, it's about building better businesses, but I'm still not quite getting the attention of the board. So perhaps I need to use, rather than the carrot, the stick as well. What would you flag to them might not be on their mind today?
Well, look, some of the risks of getting it wrong are self-evident. The regulations, and so there's laws and regulations, and then there are standards, and lots of businesses are flocking towards standards. There is a risk of greenwashing, of getting it wrong. There is a risk of ending up getting the legal side of things wrong. So being on the side of things, but fundamentally it's a question of judging where your accountability, where your circle of accountability lies, and in where things are today, and certainly where they're heading, that circle of accountability is widening way beyond legal.
And just to be clear, Alex, when you mention that, you're talking about this wider group of stakeholders as opposed to shareholders. Have I got you right?
Yes, absolutely. It's the wider group of stakeholders, and you know, for example, if one looks at value chains and supply chains, and you know, Ollie, when we were talking about this earlier, I think you mentioned Boohoo. You know, last year, of course, had a very difficult time. On the 5th of July, the Sunday Times put out an article alleging that there were unacceptable working conditions and underpayment of workers, not in the company, not even in a direct supplier, but in the supply chain for that company. And immediately that did reputational damage, but immediately the share price fell, and really fell very dramatically. What's interesting, just to finish that point, Ollie, is it is not actually that part, which I think people can grasp very easily, but is the response that the company made to that, which is within less than a week, they appointed Alison Levitt QC to come in and do an independent review. And they had to do that. And if you look at the response on the share price, the response of the business, and today, if you go on their website, they've got the review and they say they've implemented 40% of it. You know, that is what is effectively putting them back on track.
Brilliant. And that transparency, very important. Alexander Rosefinal, thank you very much indeed. Making a brilliant case there for why it is important to have these sensitive conversations, even if you fear you might be kicking over a hornet's nest somewhere in the mix. Very powerful indeed. Well, how does one of the world's leading investors approach all of this? Well, let's ask them. Peter Michaelis joins us from Lion Trust. Good day to you, Peter. Thank you so much for joining us. You're head of sustainable investment. Someone watching might wonder, aren't we all sustainable investors now, or can we be? But on a serious note, you're shining a light for lots of people. Give us a sense of how you approach what you do.
Okay, Ollie. So we actually set up our strategy, the Sustainable Future Strategy, way back in 2001. The aim has always been to select those few companies for our portfolios which will deliver superior returns because they're sustainable businesses. So that's been at the forefront of our offering. In addition, for our clients, as well as aiming to deliver superior returns, in addition, we aim to engage with companies that we invest in to improve the way they manage their businesses. Now, from the investment angle, and you know, that is our prime purpose, you could ask, well, okay, why is there an investment logic to selecting these sustainable companies? And we really feel there are two aspects to it. The first is that we believe that sustainable companies have better growth opportunities. And the reason for this is if you look at economic growth or economic development, it has tended over decades, even centuries, to not just be in terms of quantity, in terms of growing the economy. It's about changing the nature of the outputs of that economy to make our world cleaner, healthier, and safer. And you can see that in statistics around whatever child mortality, urban air pollution, road deaths. You know, these are all on positively declining trends, and that's delivered by businesses. You know, and so businesses which are at the forefront of, you know, delivering products and services which make our world cleaner, healthier, and safer should experience stronger growth. And we believe that tends to be underestimated by most investors, because most investors look at your revenue and say, one number is equal to another number. We think there's a qualitative difference between companies which are benefiting from these sustainable trends. The second aspect, and this is the second dimension to businesses, is how do they manage their businesses? How do they run their business? And in Sam's parlance, how do they manage it in the interests of all stakeholders? So, we look at how businesses manage relations with their employees, their customers, their supply chains, and to reference the boohoo example as well, and wider society. If they're managing those aspects well, they're more likely to be able to deliver on their business strategy. And so it's these two fundamental aspects that we look at when selecting investments for our funds.
Yeah, that's very clear, Peter. And so where are you on this transition yourselves between, I guess, the investor, the older school investor, not you, who would have just simply asked some tough questions and been happy with some great answers, to use the phrase? You're actually looking at far richer data, I suppose. Tell us how you approach that aspect and why, frankly, a good anecdote here and there doesn't cut it.
Yeah, and that's sort of, I think, absolutely critical. I mean, when I started as an analyst in sustainable investment, there were probably half a dozen companies in the FTSE 100 that even produced sort of any environmental data at all. That has now changed, and you see a plethora of glossy brochures, and everyone saying it's in their DNA, and as you say, lots of wonderful anecdotes. The way we approach it is to say, okay, this business operates in this particular sector, whether it's consumer sector or industrial sector. What are the key environmental, social, and governance factors that matter for that sector? We predefine what we're looking for, and then we see if the company produces information on it. Because frankly, if they say it's so important to their success that they're not even measuring it, that tells a massive story. But there's just one other sort of aspect which I think is important, and this goes back to what Manjula was saying about just how critical this situation we're in now is that while companies have had a fantastic record in delivering great outcomes, we face sort of really significant challenges in terms of climate, biodiversity, equality or fairness within society as well, which companies are going to have to address. And I think there's much greater recognition of that now.
So what, Peter, do you say to the non-exec tuned in who says, look, my board are fighting fires, they're in the trenches, they're running their business, you're asking them to harvest this huge amount of data, half of which, quite frankly, we don't know where it is. Could we file this under distracting at best?
Well, if it's irrelevant to the business, then it's irrelevant to the business, that's fine. But if you're a consumer company and you're not measuring the sort of net promoter scores of your customers, or you have a large employee base and you've no idea what your employee turnover is, or the engagement score of your employees, and you've no idea who your suppliers are, how far they've subcontracted out, then that's a real omission, I would say. So it's not just about risk, it's clearly about opportunity as well.
And it's a telling omission. Peter, maybe you can help us bring this to life even more with some examples of a company that you've backed, how you approached asking these sort of questions, and why ultimately you decided to say yes.
Yeah, well, I mean, and I think it's important to say that when we engage with companies, it's over many years. So, a couple of examples. We invested in Gym Group. So Gym Group are in the sort of budget gym, they would say very good value gym area. And we like them, obviously, because of the health benefits they bring, and they produce a lot of information on the improvements to health from people who go to the gym, and the fact that 20% of their members have never been to a gym before. So they're really, but they faced an issue around employees, where typically a gym has 2 full-time employees, and then they have a dozen personal trainers. And there used to be this kind of I guess, barter system where those personal trainers got free access to gyms, but they weren't being paid and they didn't get the rights of employees. And that became caught up in this whole employee issue around employees, workers. We engaged with them on that, and they adopted a very proactive approach, offering full-time employee status, benefits, holidays, all of those entitlements should the personal trainer want to take them out. Roll the clock forwards, and then obviously in once COVID hit, those employees were then allowed to get furlough and all of that. So it ended up being a much better outcome, much better employee retention, much better customer experience, and happier investors.
Excellent. Now, without wanting to draw your attention to a company which might or might not deliver in 2021, how confident are you that companies eyeing a listing are taking this seriously enough?
I mean, it is tricky, and I have to say from my experience, when companies list, they tend to not have great disclosure on these issues. So, we have a matrix rating system. When companies first list, there's a paucity of data. And so they tend to get very low rating, and it takes them a few years to build up a track record. And so that's something we'd love to see improve.
So on that then, what's a question that a non-exec tuning in today should be going back to their board and asking?
Well, I think they could start with the risks that they detail in the annual report and say, okay, well, how are we assessing these risks? What's our target for improving them? They could also say, because you could take one specific example, like carbon and carbon emissions, because carbon emissions are going to affect the entire economy, whether you're a high intensity emitter or not. And just say, let's take this one issue. Now, the rule of thumb is you've got to halve emissions every decade, wherever you are in the economy. And to just say, well, how are we going to get to zero by 2050? What is our trajectory? That's a good starting point, I would say.
Tough questions. Good. Well, stay with us, Peter Michaelis from Lion Trust Asset Management. Thank you. If you've been asking questions, you can put your questions to the whole panel or the whole guest group or to an individual throughout this session. Thank you to those who've been doing it. Why don't I ask all of my guests briefly to join me back, because I've got questions for them. One question, as I see them reappearing. Thank you for your input so far, and I know that we've not yet met Raymond, but we will properly shortly. One's around B Corps, B corporations. Graham asks, are B Corp tools too US focused and wide for a wide take up by UK companies? Has anyone got a sense on B Corps? I'll take an offer on that. Alexander, yes, please. And we'll keep it pithy because I've got a few questions and then we're going to get back to the main plot. Alexander.
Yeah, I mean, we've been supporting B Corp on a pro bono basis since it came to the UK about 5 years ago as a firm. And we totted it up actually 2 weeks ago. We've helped 80 firms with their legal change. A fundamental part of B Corp is you change your constitution to say positive social and environmental impact as well as profits. I think our experience is that it's a very useful framework for UK companies, just as it is for US ones. Okay. And I think just to extend that to say, to the extent that we've actually put ourselves through the B Corp impact assessment of our business, and we have ourselves found it very helpful. I mean, there are a few Americanisms in it, but it's useful.
All right. Okay. Thank you. Mangela, couldn't a board say, look, we're busy. We're going to double down on all of these ESGs. We're going to work with the platform that you're going to describe to us soon. I don't think we need B Corp, do we?
I think there's a really big consolidation going on at the moment. So if you look at what the regulation's about to do, it's going to mandate sustainability reporting. There is a consolidation between the standards, the frameworks, the policies now going on. So one of our big, I guess, USPs of this platform is that we have mapped all of these globally recognized standards, frameworks, and policies. The company doesn't have to think about which ones to do and how to do them. And so my advice to anyone watching this is to start from a position of materiality, number one, for your industry, and then start measuring from there. And
just say what, Angela, when you say start from a position of materiality, what do you mean?
So materiality is where your highest risks and opportunity is for impact for your sector. Right. And then you figure out which metrics to use and go from there. Right. So I'm not going to comment specifically on B Corp because I think the world is consolidating. That's one of the things that we want to help the companies leapfrog today and be at the forefront of integrated reporting, actually.
So here, and I could get a contribution from you all on this, but very briefly, Alan asks, what do the panel think of a forum for companies to share the best and worst of their experiences planning so we can all learn from real world experiences? I guess that would have to be done rather sensitively. Peter, does such fora exist? I'll just get you off mute there. Yeah, please.
There we go. Yeah, I mean, I think they do in many areas. I mean, what you tend to see though is often it's the same usual suspects presenting at many of these conferences because they're the ones that have got it. But I think I don't know, sort of initiatives like the PRI, Principles for Responsible Investment. They offer a good forum, certainly from the investment perspective, for assessing what investors are looking for from companies.
Yeah, good. Anyone else on the panel want to throw one into the mix where we can sort of share the ups and the downs on this? Does any other one come to mind?
Well, I was thinking actually something more practical. I mean, we could set one up for all our net in the AIM community just to share. I think it's more the practical things. So, for example, when we started measuring, because we're a financial service business, we don't have much carbon footprint. But actually, once you start measuring these things, there are small little changes that can make material differences when everyone clubs together. So, for example, paying our cleaners the living wage, making sure that happens. It's tiny things, but knowing what everyone else is doing is really helpful. So maybe we could have a go at setting something like that up.
And I've seen finnCap do that firsthand, broker those conversations. Sam, very quickly, I'm going to stay with you. Here's a question for you. Given this comes from Andrew Jacobs. Thank you, Andrew. Given the significant time pressures during a results roadshow, yes, should one really devote any time to the complex issues of ESG, which doesn't affect the P&L? And this could be a planted question. It isn't, but I bet you were hoping you'd get it, Sam.
Well, I think it does have something to do with the P&L in the very short term and the medium term, and in the long term, it absolutely will do. And Raymond will probably explain why very shortly. But this is something when we did it, we have all the right things in place, but the reporting wasn't there. Our FD had to spend 3 days doing it, getting the data together with HR, but it was 3 days while doing the results, and then it was done. So that was it. It's a bit of time, it's a bit of focus, but it could be done, and it was done in the mix of a very busy deal flow, very busy reporting season. So it wasn't too onerous, and I think that's why we tried to have the scorecard and have the WWG software as something that makes it as easy as it possibly can get when you've got so many other things going on.
Brilliant. No, thank you, Sam. Well, everybody, yes, now, Raymond, don't worry, because I'm going to ask you to stay behind and see me. Everyone else, please have a comfy seat in our virtual green room. Raymond, I was happy to see your hand raised there. Raymond Greaves, you're head of research at finnCap Group. Please add what you were going to add to Sam, and then we will segue into the scorecard.
Sure, I'll sort of try and weave it in. I mean, what I was trying to say is, I think people should stop seeing ESG as some sort of absolute goal. It isn't. It's a journey, and you have to start somewhere, which is for a lot of companies, they're literally at ground zero, and your progress on ESG will not be one big bang, huge focus 1 year, and then it's done. It's a journey.
Yeah, totally.
We talked about B Corp. B Corp is, for many companies in the UK would be the end of the journey, but it would probably take many companies years to get there. Yeah. There's no point looking at B Corp. Let's look at the incremental stuff we can do now to get better.
Got it. So on that process of holding up a mirror to the organization, I'm slightly unfairly, Raymond, going to give you 5 minutes to talk us through the scorecard, what's on it, and how does it work. Raymond, over to you.
I'll try. I'll do my best. So I'm sure a lot of people on this call are bamboozled by a lot of what's in ESG. There's so many TLAs, 3-letter abbreviations, standards, frameworks, policies, and so on and so forth. What we realized as a broker where we could help companies was to provide them with some sort of starting point in this area. So to help companies, or indeed investors, get started on their ESG journey, you see, Ollie, journey, not endpoint, we've created a simple scorecard based around 15 factors, only 15 factors. There's 5 in each of environmental, social, and governance. And as far as possible, the factors are quantitative, unambiguous, uncontroversial, and fairly easily obtained, and hopefully meaningful, okay? So having completed a scorecard, this means we can then give companies some basic advice on how they rank against their peers and the wider market, and what they can do now to kickstart their ESG journey. So you'll be pleased to know that we've actually done this for finnCap. It was the first company we did on the scorecard, just out of interest. So if someone can show my slide with the finnCap scorecard on it, it's a little bit busy, quite a lot of numbers in there, etc. But just very quickly, what sort of factors are we looking at? So under environmental, these are very quantitative measures on environmental intensity of the business. So we look at energy consumption per unit of revenue. We look at waste production per unit of revenue. We look at water consumption per unit of revenue, and other factors like that. And we also sense check if a company's got an environmental or sustainability policy. On the social side of things, we're looking at staff turn. I noticed that Peter mentioned that specifically. We also look at the amount of tax companies pay. In the world of ESG, paying tax is a good thing. And we also sense check the policies that companies have got. Do they have a discrimination policy? Do they have a community outreach policy? Do they have an ethics policy? And then on governance, most people will be very familiar with these key aspects, but we look at a measure of board diversity, which is the percentage of women on the board. We look at how many independent directors there are. We look at how much does the CEO pay themselves relative to the UK median. And we check the CEO chair roles, are they split, and does the company adhere to some sort of corporate governance code. And so we'll be the first to admit this is very simple. It's not going to get you to B Corp status by any stretch. But for companies that haven't really looked at ESG, this is a process they could complete very quickly. I mean, normally I can get 2/3 of those data points from a company's annual report and accounts straight away. And then the finance director can usually fill in the rest. So having done that for finnCap, what could we tell ourselves and what have we done on the back of it? And this is the sort of conversation we've been having with our corporate clients as well. And I've been amazed and actually very pleased at how useful many companies have found going through this process just to kind of get their journey started, rung one, as Sam mentioned. So doing our own scorecard, Ollie, first thing we found was we didn't have any of the environmental data. The reality is we're a low carbon impact business anyway. We're a bunch of people sitting in an office. We're not an aluminium smelter or something like that. But the point is you've got to have the data, and we hadn't got it. So the first thing we did was we went out and got our energy and waste and water consumption stats. We then realized that for the carbon footprint we had, we could then offset it, by planting trees and doing something positive like that. So we've got our environmental data, and then we've gone and done something positive, like start a carbon offset program on the back of it. We then realized we didn't have an environmental policy. So do you know what? It's not very difficult to write one. So we've written one, and we'll be publishing that very soon. And that then sort of will complete our set of environmental data. On the social side of things, we didn't have a community outreach policy. So we've actually formed an ESG committee within finnCap. And as part of that, we had a discussion as to what could we do for community outreach. And so we've come up now with a volunteer program, and we give our employees a couple of days off a year to go and volunteer for various good causes. So that's something very positive that came out of that. And then on the governance side, we scored quite well. The only sort of chink in the armor was we didn't seem to have many independent directors relative to our peers. So we've gone and corrected that now as well. So just from the very simple exercise of going through this scorecard, we came up with 3 key things, and we need to sort out environmental data, get our policies in order, and maybe get another independent director. We've gone and done them. It didn't take us very long at all. And so now Sam can go out and talk to our investors, fairly confident that we look okay on rung one on ESG and that we've done something about it. And then If we want to get to rung 2, which is, start conforming precisely to things like the PRI, the GRI, whatever other TLA you can think of, you then need Manjula and her software at WWG, which she will obviously come and talk to you about. But that's the scorecard in its essence.
No, thank you. And Raymond, thank you for telling that story in a way that made it so clear that you have walked the walk on this. I find that actually very inspiring. So thank you. That's Raymond Greaves, Head of Research at finnCap Group.
Well,
stay with us, please, Raymond.
Sure.
Raymond gives a nod to Manjula Lee and her team at WWG. Let's welcome Manjula back to our screen. Manjula, we've heard about rung 1, rung 2. I guess WWG is the whole jungle gym. I mean, this is the whole thing. Tell us a bit more about what you've done and how it works. Because in my mind, I'm getting this image of, a CEO or a board, standing in front of a huge dashboard almost. But in your words, tell us.
Yeah. So if I could put up that slide, which is the solution slide. So you saw that messy slide of the problem, right? And everyone's in pain and don't know what to do. And so this slide here, and I hope you can see it because I'm seeing a different screen here, but essentially what we've done is brought some order to the disorder. And so we can help people execute from day one. So in that left box is the platform. It's called G17 Eco. It stands for the 17th SDG Partnership for the Goals. And we can really come onto a platform and start measuring performance sort of straight away. On that platform, we have, the first step we did was we mapped all those globally recognized TLAs together, and we found the commonality between them, and we also mapped them to the backbone of the Sustainable Development Goals and the targets. From that taxonomy, we were able to create one unified digital survey, if you will. Instead of 70 surveys you have to fill out, you can fill out one that then maps that to the different standards, frameworks, and policies. What the partnership with finnCap has also allowed us to do is to take those 15 metrics, rung 1, and for all finnCap clients, they will be able to answer those 15 metrics on the company tracker, which is an app on the system, to get going on their sustainability journey. If they then want to take more modules and map themselves against more standards, frameworks, and policies, like, for example, the TCFD that we mentioned, which is going to be regulated, they can do that end to end on the system as well. So from that one harmonized survey, we were able to create a methodology with all of the leading sustainability experts, including academia from around the world, on a measurement, impact measurement methodology, which will help companies measure their impact and contribution to the SDGs in real time. Not 2 years later or a score that you get later on. It's in real time, so it can advise you quickly to be able to make decisions from that. So, so that's all the work that we did to kind of put the order together. We built the company tracker. We've also built portfolio tracker for the investor community to nominate their companies to the platform at scale. And from there, companies can come onto company tracker. They can collect data, process data, disseminate data, and aggregate data, and share that with their stakeholders, like their audit firms, to verify that data, and then into their investor community, as I said, in real time. So if we turn that slide off now, we heard today about from Alex and Peter and Sam and Raymond, it's going to be regulated. Your investors want it. Your consumers want it. Your employees need it, and everyone is going to ask you to prove your sustainability credentials to really survive and thrive in this new world. But my sort of sentiment here is those are compelling reasons to do it. Don't just do it because it's a tick in the box and it makes sense to do it commercially. Do it because we are all human beings and we're all on this planet together, and we have a seriously ill planet at the moment, and we have to move. And business absolutely has to be a force for good. And we can be. And you've seen now the data that it is absolutely economically the right thing to do as well, right? You're going to see outperformance and growth and prosperity, more than you would see of a non-sustainable company. So that's number one, is do it because it matters to you and because that's the right accountable thing to do. And then the second thing is that, you know, we really see that when you come onto a platform like G17 Eco, it's not just a bit of software. Actually, we kind of see ourselves like coming into, I love the gym analogy, and you know, we're coming into, it's like coming into a gym. And we're going to walk that journey with you to peak performance. So it's not like you're just, you know, there and by yourself and using a bit of software. We as Worldwide Generation come alongside you and we really help you to get from, you know, 0 to the peak performance of where you want to be. And so what's the, you know, Ollie, I've got a question for you. You know, what's the first thing that happens when you join the gym?
And I presume it's not, I ask where the cafeteria is and where. No, to the best of my recollection, well, don't they ask you they ask you about, well, they sometimes ask you why you've joined in the first place, and they probably want to take some measurements, heaven forbid, to start us off, right?
Absolutely, and that's exactly right. You know, when you go to a gym, they definitely ask you why you're doing it, because unless you have a purpose for doing it, you know, you're not going to keep going with that journey, as Raymond said. Number 2 is that they do have to take a baseline of you, of where are you today and where do you want to get to, and set those targets so that they can build the right program for you to be able to get there, right? So that, as board members, that is your single starting point, is that you as board members are measuring risk, number 1. When you look at your business through a sustainability lens, that is exactly what you're measuring, is risk, right? Because you're looking at all the elements of your business holistically and sustainably. So the first thing that you can be advising your companies is to say, let's look at the risk. Let's look at it through a sustainable lens, number 1. And as through the company tracker, we will be able to help you define what is material to your sector, as I mentioned before. It will give you a list of metrics to say, here are the metrics that matter to your sector, where you have the greatest opportunity for risk and opportunity. Now, start there, and that provides the measurement metrics, if you will, when you go into your gym, right? Then we have to actually measure you. We have to baseline you to say, where are you now today on that? And without that, you don't know what targets to set. Without that, you don't know what changes to make. And finnCap said that themselves as well, is that they had to do that work first, get the data and see where they were today. So number 1 is start today and start with the right metrics and get a baseline. That's your starting point. The second bit is don't shy away from being brutally honest in your business. Have that culture embedded now, today. No one has to see it outside. No one's going to name and shame you. It's about getting your own version of your truth today for yourself. And when you have that culture will absolutely get you to peak performance, because when you're brutally honest and transparent with yourself first and say, where are we today? Then you can start to manage the risk and manage the opportunities as well, right? What gets monitored gets measured, what gets measured gets managed. So this is the really important piece for all board members to kind of acknowledge and see today. The second thing is, the third thing really is that, going back to the gym analogy, we're like, do you know what? I'm just going to lose some pounds first before I get on the scales, because that makes me feel better. I'm really urging you, don't make statements on the website or claims about what you're going to do and make those targets until you get your baseline first and where you are today. You know why? Because the greatest, we touched on it a little bit today, but the greatest thing you can do right now, businesses that build trust is going to be the highest currency for economic success. Trust with your stakeholders. Do you know that we are now in a time where, for the first time in history, consumers trust their brands by about 7%. It used to be the completely opposite. We used to love and hear our brands and hear what they're telling us and wanting to buy their products. now the trust has eroded to 7%. If companies that are willing to leadership, say in leadership, it's not about, hey, we've got our act together now. It's actually saying we are what I call leadership, vulnerability and courage. We are here today. We're going to put our hands up and we say, we know this is important. We are going to be accountable. We don't have it all together yet, but we're going to start the journey today. That has more power, and that will help you with your fundraising, your valuations, your everything with your, if you can start that and build that trust.
Got it. Thank you, Manjula. Well, stay with us. Why don't I invite everybody back, the reunion, because I've had some brilliant questions coming through. And as we see our guests reappear on screen as if by magic, who have all been listening to Manjula explaining a bit about WWG. Out of interest, Manjula, when I've got my printout, my readout, my sense from the dashboard, to what extent is that more for my internal knowledge, and to what extent is it today in a language, so to speak, that investors will understand?
Yeah, and so that's exactly why we've used the Sustainable Development Goals as the backbone of the test that we're all doing. Because if we are all just doing, our own metrics and our own measurement, we have no standard to say, well, what I'm doing actually working, right? So the Sustainable Development Goals have already said, what is the impact we want to see by 2030? We work backwards from that. What are the outcomes we want to see by the 169 targets? We work back from that. And what are our activities that we're doing to contribute to those global deficits that are in the world today? So that's a really important point, is that they give us a framework and a language to speak to investors then.
So let me put a point to you, Alexander Rhodes, and this question may display a little bit of legal ignorance, would you believe? Manjula makes the point, start today, show up at the gym, as you are, and nobody's going to see this, right? Now, alarm bell goes off in my mind saying, hang on, up until that point, couldn't you have denied knowing about that absolute clanger hidden in your supply chain? As soon as you know it's there, haven't you crossed some sort of legal Rubicon?
Well, Ollie, the answer, of course, is yes. That with knowing about things comes obligations to deal with them. But I think actually I would invert your proposition and say that underlines the importance of getting on with it, because otherwise you have gremlins, and this is Manjula's point around risk, sitting in your organization that you don't know about. So I suppose my focus and where we often get brought in is about the how. How do you manage the transition in a safe way? How do you manage the transition in a way that allows you to identify the risks and manage them? And getting on top of your metrics is fundamental to that. But only if you do that in an appropriate way are you then able to sit there and see what opportunities are on the other side.
All right, but Manjula, let me put what someone might be thinking, which is, look, if I fling open all of the closets, I might get crushed by the skeletons, to be honest. So is there an argument that squares this circle where one paces oneself?
Absolutely. We always say start small, and I think what finnCap have done with their rung 1, 15 metrics, start with that. Those universal questions that every company, irrespective of your industry, should be able to answer those questions. That helps you, as I said, get your baseline today, and then start layering that with, okay, what are our material SDGs for our sector, right? Let's start impacting them and contributing to them by the products and services, by our operations, by external activities that we're doing. That's basically the journey. So it's not like, get everyone, like invest huge amounts of money to kind of get this going, and it takes 2 years to start the process. Start small, start today, build the muscle, and then
Got it. And Raymond, I think you'll agree with that.
I just wanted to add something to this. There seems to be a great deal of concern that as soon as I start my ESG journey, I'm going to get this avalanche of skeletons coming out of the closet and bury me. We did the scorecard on all of our corporate clients. We've got 120 corporate clients. And the reality is most of them are pretty good. When you're looking in the UK small mid-cap space, we don't have aluminium smelters, things with huge energy consumption, for instance, that are going to get clobbered on the environmental side. Most companies, because of investor focus, are already quite good on governance. They might have a few things to tweak here and there, but they're not, a horror show on governance. The area that most companies haven't really looked at in any great detail is the social side of things. But again, if our snapshot, which is 15% of AIM, by the way, 15% of the small company space, showed that there weren't any howlers in there either. The only thing the companies needed to do was formally implement policies where they probably had tacit agreements already, but they hadn't codified it into a formal policy they could show on the website. So I think if there's one big conclusion from our scorecard exercise is that most small companies haven't got anything to fear. They just need to get the data and put the policies in place.
Yeah. And in terms of, Sam, in terms of the way the tide is turning, I noticed finnCap asked small company fund managers, 85% of them said they plan to use ESG factors, what we're talking about today, in future investment decisions. 85% of them.
Well, actually, when we did our analysis of the institutions as part of our scorecard report, what happened 3 years ago, there are probably a third of people thinking about this. Today, it's about 2/3, but in the future, 100%, every single institution said in the future, don't know when that future date is, they will need to look at this sort of reporting. And to me, it's a bit like, the tick box of, do you have a chairman and chief exec who are independent people? Do you have a CFO that's on the board as a position responsible for finance? It will always become, to me, do you have proper ESG policies as a baseline? Not to say, are you this massively impactful company? It's just, do you have the basics? Do you have the policies? Do you measure your carbon footprint? What do you do about it? And it will be a box tick. And I think that's the worry, is if that is coming and you don't tick any box, you could be left exposed.
Got it. Now then, everybody, I'm going to fire some questions at you. Thank you if you've been asking the questions, and forgive me, guests, I'm going to ask you to be as pithy as you can, because we could talk for a longer time about this. Peter, here comes one for you. Are fund managers, Mark Tubby, thank you for this question, Mark. Are fund managers' own ESG reporting requirements driving disinvestment in companies who are not publicly addressing ESG? Good question, Mark.
Yes, it depends. It depends, of course, on the strategy. I mean, our sustainable investment is probably, a really, really strong brew of sustainability coffee, whereas others are more dilute. But so our clients would certainly not expect us to be investing in companies which don't provide any information on their sustainability performance.
Well, there's a tougher question coming your way then. So I'll stay with you, Peter. This is David Wilkinson, and this really gets to the crux of it, I think. Are most investors really willing to accept less favorable short-term profit measures in order to build longer-term measures for sustainability and purpose? Thanks, David Wilkinson.
Are most investors, was that the beginning of the question? Yeah. Well, yes, I think most investors are not investing for the short term. Most investors, if it's your pension, you're going to be in there for decades. So emphatically, yes.
Yeah, good. That's a pithy answer.
Sorry, I should just add on to that sustainable investment strategies over the last 15 years have, for the large part, outperformed handsomely their mainstream peer group average. So, there's evidence to back that up.
Yeah, and has anyone on the panel got a sort of pithier framing on that? I mean, handsomely will do, but I want to give our non-exec director something that they can go back to the board and say, have a look at this. What comes to your mind? Raymond, please.
Okay, so when I started writing this report on ESG at the beginning of last year, one thing was very interesting when we started talking to colleagues and people outside the business. A lot of people felt that ESG was some sort of rogue wing of Greenpeace, and that it was somehow mutually exclusive with actually making any money. And the sense I get from that question is that ESG compliance means it's going to hit my profitability. I would suggest it's quite the reverse. You know, what ESG gets the heart of is actually making a business sustainable. And it doesn't mean just in terms of sustainability, in terms of the environment and the local community. It means sustainable in terms of profitability as well. It's about addressing the risks that are going to drive your business into the ground. So, you know, for me, what I would say is ESG, really, it codifies in a high level sense how a good business should be run.
So give me more on that, Manjula. What if someone says this does have a ring? Has this come from marketing, they might say, because I'm not convinced yet. We have got a skeptic in the audience, and someone close to you might be a skeptic if you're tuned into this. Manjula, just let's get back to the bottom line.
Oh, yeah, I want to say that don't even think about it as ESG and something else over here. Think of it as just bottom line strategy, right? It's bottom line risk, it's bottom line strategy. And from that, you need to then, you know, really understand what you're measuring and what you're monitoring. And where the regulation is going, and you know, Alex, you'll probably know this as well, is that what we're going to be looking at for businesses is integrated reporting. So even ESG is going to move on, because ESG is a one-dimensional lens of the company. Are you doing this? Yes or no? Do you have a policy, etc.?
Forgive me interrupting. Just give us a deadline that will make us sit up and take notice, because we've had certain EU legislation, which I know we will feel the ripple effect, but has been taken off the table, off some tables. Give us a line in the sand as you see it.
So the regulation is already here. The announcements have already been made. The UK government already said that TCFD will become mandatory for all companies to report against. That is just keeping on layering. So it's
when?
Well, actually, Alex, you can probably give the dates, but even this month, the announcements were made. I think companies have 2 years to get it together in terms of being able to report against this and get ahead of the regulatory wave. But the pension funds and the asset owners are already under pressure today. Now they have to give to the regulator what is their underlying assets and securities they're investing in. That is going to put pressure on the fund managers, and the fund manager will absolutely put pressure on the companies. So even if regulation it comes in 2 years, the regulation for the underlying asset and where that money is going is here already now today. So
let me get your manager. Thank you, Alexander. Let me get your take on this. Here's a question from Richard Sells from Strix. How does a company talk about positive effects of products and tech beyond its own performance? So, because the point being made is environmental measures tend to look at own company performance. So I guess it's hinting at the sort of, it's not a halo effect, but it does speak to that wider stakeholder group.
If I understand the question correctly, I mean, the focus is on impact, you know, and that's the sort of the language, and it's, I think the trajectory is to move from values. We have core values. This is in the DNA of everything we do, towards actually this is something that's gritty, and that we're measuring it to Manjula's point, the importance of reporting, and we're actually looking and measuring on the impacts that we have and being able to report those. The second part that's relevant to this question, but talks to the previous question as well, is that all of these standards and all of the reporting obligations affect your relationships with your stakeholders. And in good old English, what that means is you have to be aware of what's happening in your supply chain. And that means you have to ask questions of the people in your supply chain and in your value chain going the other way too. That's right. And so it will affect you directly, and it will affect you indirectly, and you have to have those questions. And of course, that's where some of the value comes in terms of the implementation of this approach.
Brilliant. No, thank you.
Can I just add just on that, because it is critically important, because you have to talk about the product you make as well and service you deliver, because if that's not having a positive output on society, then then you wonder why you're in business. But that has to be set against the impacts of your operations as well.
Yeah, very helpful. Manjula, on a very practical note, are you happy to share a couple of the slides that you've shared with us today? Will that be possible?
Yeah, sure. And, you know, I honestly urge everyone who's on this call today, play the video with your board, play a video with your C-suite and in the room and have the conversation. And we would love to have the conversation with you as well, you know, and I'm sure finnCap as well to come and speak to you how we get started.
Brilliant. Well, on that note, Manjula Lee, thank you so much from Worldwide Generation. A very, very positive partnership there with finnCap Group. Of course, to finnCap's Head of Research, to Raymond Greaves. Thank you for joining us. And thank you for speaking so openly about finnCap's own journey on this. Brilliant. Peter Michaelis, one of our legendary investors, thank you for all that you do and for sharing it so clearly today. Thank you, Peter. Thank you to Alexander Rhodes at Mishcon de Rea, Head of Purpose. Thank you, Alex, for your thoughts. And I wonder if I can turn to you, Sam, Sam Smith, founder of finnCap, just for a closing thought or two as we move into our day.
I think the biggest things I took from that is, you know, this is about building trust. It's trust in your company, from your employees. It's really important. And it's about starting the journey. I think what Raymond said was very key. Don't be fearful of this. Don't think it's nothing to do with profit. Don't think I'll do it in 2 years' time. Just think, look, start with this scorecard. It's free, it's easy. It will take you half a day to just get that data, and it just starts the conversation. Get it on your board agenda. Just start thinking about it. Don't be worried about it. Doesn't matter where you start. It's relevant to everybody, and this is coming very, very fast. I've never seen, you know, this mega trend in my working lifetime come this fast. So it's going to be here very soon. So just don't do nothing. Just start today.
Okay, just start today. Well, if that means sharing a link to this recording with someone that you think should get their heads around this in a little more depth, then please do. But for now, thank you to all of our guests today on behalf of the whole team at finnCap Group. To put today in context, this is one of a series of events, What NEDs Need to Know, and we would love to welcome you to future events. And indeed, if there are particular subjects or angles that are on your mind and on the mind of the boards that you serve, then we'd love to know. So please keep your questions coming. And if you've got follow-up questions from today for finnCap and for WWG, we would love to answer those. So for now, thank you to all of our guests. Thank you to you for tuning in, and thank you to the whole team behind the scenes and on camera at finnCap Group for supporting this. I hope you found it very valuable. For now, though, I'm Ollie Barrett, and it's been an honor to host this webinar for you. Thank you until next time. Goodbye.